What they're worried about now, and I think what people are starting to talk about, is the quantitative part of the equation. We've gone from QE, we're going to QT. And I think the chairman very obviously told us how they're starting, where they're starting. They're going to ease in, and they're going to expand, and we're going to the number that we were told he was going to. He even laid out, how they were going to do it, what securities they were going to sell. And the market likes that. The market has been trained to have transparency, and we got transparency.
He has this new forward guidance where he is very open about what he's going to do, and it gets priced into the market. And then we have a relief rally like this. Thought it was interesting that he opened the news conference with an address to the American people. Inflation is too high. We get it. He used the word attentive a number of times, and he used the word expeditious a number of times in terms of how many rate hikes we're going to see to try to correct it. Yeah,
he opened up talking inflation's too high, labor market's tight. He talked about the PCE being 6.5%. He talked about without food and energy, it being 5.2%. And then he used the new word, adapting. We're adapting.
Well, because their view on inflation has totally changed.
Yeah, we're adapting. So I thought that was very interesting. In his prepared remarks, he came out and talked about adapting. We have a Fed that is now adapting to the new inflationary stance that we live in.
So what does it mean? We'll get another 50 basis point hike?
So look, he also mentioned, if you listen clearly, he said 2 50s. I think he admitted to 250s. Sarah, I think if you take a step back and you look where we are, I think we have 5 Fed meetings left the rest of the year. There's no August and no October Fed meetings. He admitted 2 already. I think most people think Fed funds end the year around 3%. So that's probably conventional wisdom right now. That's where the market has it priced in. That would most likely mean we would have 350s and 225s. We don't necessarily have to have the 350s in a row. So the chairman already told you it looks like 250s for the next 2 meetings. The next 2 meetings, June and July. Then we take a break. We actually have August off. So when we come back in September,
25.
The chair will look, he'll have a lot of data between now and September. So if things are starting to moderate, inflation's starting to moderate, he's having his effect on demand, which the chair also admitted. He can't deal with the supply side. He can deal with the demand side. If he's having the outcome effect he wants on demand, then he's got optionality when he comes to September. If he's not having the effect, September could be another 50, and then you could have November, December be 25s. So I think he's laid out sort of the roadmap for the next 2 rate hikes being 50s.
So what does it mean, Gary, for the markets? Because stocks are zooming here. And bonds are rallying. The curve is steepening, the 2-10 steepening. It all makes sense. It's priced in. But do you see a potential for more of a rally beyond today on this idea that the bond market just got too hawkish?
Look, Sarah, I think a lot of people have priced all this in. And the fact that the chair came out, he acknowledged where they were. He reconfirmed they're behind the curve. He said we're adapting. We're going to do what we have to do. We're no longer talking. He didn't mention the 8 or 11 increases that you mentioned last meeting. He's now talking about 50s. I think the market's starting to say, okay, we've got this pretty well priced in. I don't think there's a lot of surprises out there. We've taken a lot of the fluff out of the market. We've taken a lot of the hot air out of the market.
The excesses.
We've taken the excesses.
The excesses have been removed.
Good word. We've taken a lot of the excesses out. We've now got some real value. So the stock market today is reflecting some of those values, some of those asset prices that have been beaten down. And the rate market had already moved. We already saw 10-year rates more than double. We've already seen, 2-year rates more than quadruple. And so we've had the movement. The market has put the movement into rates already. And the market's sort of getting a vote of confidence that they're right where they've got things priced. And it's probably not going to get much worse than that. And so that tends to lead market practitioners to say, okay, we sort of understand the outcome, and we maybe have a little bit more predictability today than we did last week. And we like predictability, and therefore we are willing to put a little bit more risk on the balance.
And I think also even hawkish Powell isn't too hawkish. Could be more hawkish. Every sector's higher right now, by the way. Dow's up 700, more than 700 points. Every Dow stock is higher. Gary, stay with us. We do want to bring in our senior economics reporter, Steve Leisman, who is part of that